Hey, what is up, guys? So, every mutual fund investor should know this difference between mutual fund and index fund. So, if we'll talk about the mutual fund, can be categorized into an active mutual fund and passive mutual fund based on the investing style. So, if I'm talking about active managed mutual fund, are where the mutual fund manager keeps buying and selling the stocks from the portfolio. If you ask the logic for active management of the mutual fund, the fund manager will say, I'll actively break each stock in the mutual fund to make sure I buy the potential stock and remove the underperforming stocks. So this ensures high return for the mutual fund as compared to index. So before we proceed further, please note that the main goal of every active fund manager is to beat the benchmark, that is index. And index, what is index? So index is collection of a stock in a specific category. For example, Nifty is an index of top 50 companies in India. Sensex is an index of top 30 companies in India. Likewise, we have multiple indicators. Like actively managed fund charge additional fees, which is called expense ratio, to manage the fund. It directly impacts the overall return from the mutual fund, but the fund manager try to compensate it with additional return compared to the index. However, another style of investing is passive investing in the index fund or ETF, where the mutual fund manager does not buy or sell stocks on a frequent basis. So passive investing has very low expense ratio. If I put a simple language, the passive investor says active investment is a just way for mutual fund manager to make money by charging high fee. When everyone has access to all the information for investment, it is useless to keep buying and selling stocks, because active management fund cannot beat the benchmark, that is index, in the long run. So in fact, the return from index fund would be higher than the active mutual fund. Hence, it does not make sense to pay high expense ratio in an active mutual fund. But the question is it really impossible to generate more return in India with an active investment as compared to an index fund? So we'll compare UTI Nifty index fund with Axis Blue Chip. So Axis Blue Chip in 2016 by 6.91% return. However, Axis Blue Chip has outperformed UTI Nifty index in 2017 and 2018. So the difference in 2017 has been 10.02%. However, the category average of UTI index has outperformed better than the category average